If you want to invest in the S&P 500 because you feel the US will continue to outperform, then you absolutely should. But in this video, I'm going to give you some alternate options in case you feel otherwise. I've got 4 different options for you, and they don't have to be absolute. It doesn't need to be one or the other. They can be used as part of a portfolio. The first one is global real estate. Now, real estate historically has performed really well, and it gives you a good mix of capital appreciation and income generation via dividend payouts. So if regular and consistent income is something that you're looking for, because the income is derived from people essentially paying their rent, this could be a good option for you. By also utilizing an ETF such as the VanEck Global Real Estate UCITS ETF, it allows you to have exposure to the property markets without having to go out and buy physical property. This ETF invests into real estate companies and real estate investment trusts. Real estate does usually behave slightly differently to your traditional equities and bonds, so this could be something you look to have alongside those traditional investments. It's also a good hedge against inflation because property values and rents tend to rise in line with inflation. I've gone global instead of domestic real estate funds, simply just because it allows you to capture opportunities in diverse markets all around the world, and you don't have to pick a specific market or region that you think is going to outperform the rest of the world. Next, we have investing in gold. Now, this has been on an absolute tear in recent months, mainly down to the uncertainty in the markets right now. And of course, it's unlikely to continue at the pace that it's been in recent months. But over a long period of time, gold could be a really good investment to have alongside those traditional investments because similar to the real estate, it does have a low correlation to equities and bonds. And because it's a non-yielding asset, i.e. it doesn't produce an income, it generally performs better with interest rates coming down. When interest rates are higher, people can get yield elsewhere, especially things like government bonds, even corporate bonds. They're going to get a higher return, so they're less likely to go into gold. But as we've seen in recent months and the last couple of years, interest rates have been coming down, and that's a good thing for gold. Again, similar to the real estate fund, you can get exposure to gold without having to buy physical gold. Buying physical gold comes with a lot of complexities in terms of acquisition and storage, not to mention the cost of doing so. So by utilizing a product such as the iShares Physical Gold ETC, this allows you to get exposure to the gold markets without the complexity and the costs of acquiring and storing gold. This fund is also physically backed as well, which means you are actually investing into actual gold. Gold is a very long-term investment. It's not something you want to park your money in over, say, 1 to 2 years. But over a longer time period, it could be a great store of value. Next, we have investing in defense. My go-to here is the Future of Defense UCITS ETF. Specifically in Europe, we're starting to see that shift in rhetoric around rearmament and the re-establishing of the defense manufacturing capabilities of old. Of course, this is an ever-changing market and you do take on a little bit more risk by going down this route, but the opportunity here could be huge. There's always going to be conflicts around the world, and with governments committing more and more to defense budgets over the next 5 to 10 years, they're laying down markers to invest more into this sector. And with a sector like this, it's very exponential because if you see a certain country investing more in their defense, it's likely that either a counter to that country who maybe have conflicts with them, or you just want to compete and you don't want to feel left behind. And this is where governments are trying to catch up, specifically governments where they've maybe neglected their defense budgets over recent years. They're trying to play catch up now. The US has made it very clear that it wants Europe to be able to support itself and not rely on that US military support that it's had in the past. And whether you agree whether this is right or wrong, we are seeing increases in this space. And it's up to you whether you want to capture that exposure. And finally, how can we talk about alternate options and not mention a global index fund? My go-to here is the Vanguard FTSE All-World UCITS ETF. I prefer an all-world index as opposed to simply just a world index which doesn't include emerging markets. So something such as the MSCI World Index, which I did a video on recently, that covers the world, but it excludes emerging markets and just focus on developed markets. By having a global index fund, you have the most hands-off and passive approach. You're not having to pick a particular region or sector that you think might outperform. You're simply just capturing the world economy. And while in, say, 10 years' time, we can look back in hindsight and go, oh, we should have picked this market or we should have picked this sector. That's always going to be obvious when we look back. But going forward, when we don't know what's going to happen in the future, do we want to take the risk of picking a particular country, region, sector? Or do we just have that coverall approach and just invest in the world? The S&P 500 has been driven by those big tech stocks, and that could absolutely continue to happen over the next 5 to 10 years. But we do put a lot of emphasis on that recency bias, and I think it's very easy to forget those lost decades for the US, specifically in the 2000s and the 70s, where it did underperform the global stock market. A global index is also still heavily weighted towards the US, with around a 63% share of a global index being invested into US companies. With regards to past performance, it's important we don't just look over the last 10 years. We want to be looking over 40 or 50 years. That's going to cover many different geopolitical and economic events. And it's also going to remind us that things can change very quickly. And just because something's performed well over the last 5 to 10 years, it might seem obvious and it might seem crazy that we would go against that right now. But just look back in history and it will simply remind you about how quickly things can change. I hope you found that useful. Drop it a like if you enjoyed it, subscribe if you're new, and I'll catch you in the next one.